Welcome, curious minds, to another deep dive. Today, we're cutting through the noise of financial reports. We want to bring you the most critical insights from STMicroelectronics' latest Q2 2025 earnings. We're looking at a global leader in semiconductors here, and their results often give us a real pulse on the broader tech and automotive markets.
Absolutely. We've really gone through their Q2 earnings call transcript and the official press release pretty thoroughly. Our mission for you, the listener, is to kind of distill the key takeaways, help you quickly grasp their current financial health, their strategic moves, and what these numbers really signal for the industry going forward.
Yeah, it's more than just crunching numbers. We're hoping to uncover some surprising dynamics about market shifts and maybe some of the cutting-edge innovations shaping our world. So, as we jumped into these sources, what was the very first thing that really sort of grabbed our attention? Okay, let's unpack this then. STMicroelectronics reported Q2 2025 revenues of $2.77 billion. Now, this actually landed above the midpoint of their own business outlook range, which, for many companies, that'd be a clear win. But is it that simple here? What does hitting that top line really tell us about where they stand in the market?
Well, what's truly insightful here, I think, is the company's resilience. You see, while their automotive revenues were a bit below expectations,
Yeah.
and that was due to some customer-specific reasons we should definitely dig into.
Yeah, let's make sure we do that.
Right. But that dip was more than offset by stronger than expected performance in personal electronics and industrial. So this diversification, it's not just like good news, it's almost a strategic shield in what's still a pretty volatile market. It suggests they're not overly reliant on just one sector, which lets them absorb shocks in one area by, doing better elsewhere.
Okay, resilience. But you look at the headline numbers first, right? And it shows a U.S. GAAP operating loss of $133 million, net loss of $97 million. On the surface, that does look concerning. I imagine many listeners might see those red numbers and think, uh-oh, there's a deeper problem. Is that the whole story?
That's a really crucial point to consider. The operating loss included a pretty substantial charge, $190 million. And this was for impairment, restructuring charges, other related phase-out costs. You can think of it like a major home renovation, maybe. It's messy, it's expensive up front, but it's an investment in a more efficient future.
Right, the one-off cost.
Exactly. So you strip out these one-off charges, which are mostly non-cash, by the way, and tied to this strategic overhaul, not day-to-day stuff. Their non-U.S. GAAP operating margin was actually positive, 2.1%.
Okay.
And their net income on that non-GAAP basis was $57 million. So this non-GAAP view, it gives us a clear picture of their core business profitability, separate from these unusual temporary costs.
Right, context is key there. So, okay, despite some year-over-year declines in Q2, automotive down 24%, industrial down 8%, personal electronics and others down 5%. The sequential picture, just looking from Q1 to Q2, was much brighter. Every segment actually contributed to growth quarter over quarter, right? Industrial up about 15%, automotive up about 14%.
That's right. That sequential recovery is definitely an important signal.
Okay, so shifting gears from the overall financials, let's zoom in on automotive. It saw that robust 14% sequential growth in Q2, and they did say Q1 was the low point.
Right.
So what's driving this sequential bounce back, and can we get more detail on that specific customer dynamic that hit the year-over-year comparison?
Yeah, so they saw particular strength geographically in Asia-Pacific, excluding China, and also in the Americas. That helped push that sequential growth. However, their book-to-bill ratio for automotive, it dipped below parity.
Okay, and just for listeners, below parity means shipping more than new orders coming in, right? Can be a flag for the future.
Exactly. It can signal a potential slowdown if it persists.
Yeah.
Now, they clarified that 90% of an $80 million gap versus their turning point expectation for year-over-year growth, well, it was related to what they called intangible capacity fee reservations.
Intangible capacity fee reservations. What does that actually mean?
It means it wasn't a market share loss. It's more like a customer paying to reserve future manufacturing capacity, even without placing a firm product order yet. It's essentially a strategic commitment for long-term supply, not a lost sale to a competitor. And that's a really crucial distinction for their long-term outlook. They expect this customer to recover.
Ah, I see. That distinction really does change the narrative, doesn't it? It's less about losing ground, more about managing these complex market dynamics. And what's really compelling here is their strategic execution in car electrification. They flagged design wins in both silicon carbide and silicon devices for things like new DC-DC converters, onboard chargers.
Plus smart power and smart fuse for EV power
yeah.
systems. Yeah.
So for you listening, what does this tell us about STMicro's role in this, rapidly evolving EV landscape.
Well, if you connect the dots, it really shows STMicro is embedding itself as kind of an indispensable backbone for the next generation of vehicles. Take car digitalization. They're seeing strong traction with their automotive microcontrollers. They're making good progress on the roadmap, too. New products coming in 2025 and 2026. That's across their Stellar and STM32A families. And a big win in Q2 was for a one-box braking system with a leading EV maker in China. That really highlights their ability to integrate these complex systems.
And it's interesting, they're not just focused on the cutting edge EV stuff. They're also reinforcing their leadership in, let's call them legacy, high volume applications, like airbag solutions. They mentioned a third generation of a long-term partnership with a world leader there.
Right. It shows the depth of their roots in automotive. And that extends to sensors, too. Strong design momentum for automotive-grade sensors. Things like MEMS sensors for ADAS, airbag control, infotainment, even an imaging sensor for in-cabin monitoring.
Yeah, they even highlighted opportunities for sensors to improve the driving experience itself, like road noise cancellation, occupancy monitoring, seat position. It really does cover the full spectrum, doesn't it?
It really does.
Okay, so let's shift gears from automotive, where we had some, let's say, nuanced dynamics, to the industrial segment. That seemed to offer a much clearer signal of recovery. Q2 revenues, there were above expectations, strong sequential growth. And this confirms, they say, that Q1 was the bottom for industrial. So what does this really mean? Is it genuine demand coming back? Or are we just seeing inventory shifts that, might not last?
That's the critical question, isn't it? About the nature of this recovery. The company highlighted that specifically for general-purpose microcontrollers, or MCUs, they are back to year-on-year growth, showing high teens growth both sequentially and year-on-year. And they really stressed this is driven by real demand, not just inventory replenishment or customers pulling in parts early.
That's certainly encouraging news, especially after all the inventory concerns we've heard across the broader market. But what's the proof? What concrete evidence are they giving to show it's genuinely new demand from end customers?
Well, they explained that a big chunk of their industrial market goes through distribution channels. And in Q2, the sales out of their distributors, what they call point of sales or POS, that increased both sequentially and year-on-year.
Okay.
And crucially, their sales to the distributor's point of purchase or POP were actually below the POS level.
So inventory is actually being drawn down in the channel.
Exactly. It indicates that inventory at distribution is actively decreasing, moving towards normalization. They said in China, it's back to a normal situation and close to normalization in other Asian countries. Still a bit above normal elsewhere, but the trend is clear. That inventory reduction, plus their book-to-bill in industrial staying above 1 in Q2, with bookings still increasing sequentially, it gives a pretty strong indication that underlying demand is returning.
That does paint a much more solid picture for growth there. What kind of applications are driving this industrial resurgence?
They're seeing strong progress with their power and analog portfolio design activity. It's across a really wide range of applications. Things like power systems, industrial fans and drives, sophisticated motor control, white goods, solar inverters, air conditioning systems, metering solutions, even critical power components for data servers.
So pretty broad-based.
Yeah, essentially anything that needs efficient power management or intelligent control systems seems to be contributing to this rebound.
Okay, beyond these, let's call them traditional segments, where else is STMicroelectronics seeing exciting growth that might surprise some of us?
Well, in personal electronics, revenues were actually above expectations too. That's a positive sign after some softness we've seen in that market generally. They seem particularly excited by growth opportunities in their engaged customer programs. They mentioned it's driven by both increased content in personal electronics devices, meaning more ST microchips per gadget.
Right, higher value per device.
Exactly. And also the expanding market for low Earth orbiting satellites, LEO satellites. That's a fascinating area that just keeps growing.
Yeah, definitely. And speaking of future innovations, one announcement really caught my eye. It points to STMicro's role in the next wave of computing, their collaboration with NVIDIA, on a new high-power density DC-DC architecture for AI data centers, operating at 800 volts DC. Now, for you listening, what exactly does this 800-volt DC architecture mean for AI, and why is STMicro maybe uniquely positioned for it?
Yeah, this is potentially a massive leap for AI infrastructure. This new architecture, it promises much higher power density. That means more compact designs for servers, significantly less cabling, less metal ports, which translates to less material, less heat generated, and just more efficient power delivery right where those power-hungry AI chips need it most.
And how is STMicro tackling this?
Well, to deliver this, ST is combining its most advanced technologies. We're talking silicon materials, silicon carbide, CKSE, gallium nitride, or GaN, and their smart power processes like BCD using galvanic isolation.
Okay, BCD with galvanic isolation. Can you break that down slightly?
Sure, put simply, it allows them to pack more power handling capability into smaller, safer designs by electrically separated different parts of the circuit. That isolation is absolutely critical for these very high-power, demanding AI systems. Now, it's challenging, they admit, but they said they see no real roadblocks. They're aiming to be early adopters here.
And the timing for actual sales impact.
Still pretty early to predict precisely. They mentioned it potentially the second half of 2026 or maybe early 2027. So still a ways out, but a very significant development.
Definitely one to watch. And just a quick update on their embedded processing segment, particularly their microcontrollers.
Right, their STM32 microcontrollers continue to gain traction. That's really a testament to their versatility across so many applications. And the software ecosystem around them is also growing strongly. They're now nearing 1.5 million unique users. That's up from 1.3 million they reported in 2024.
Hmm.
It just confirms the strength of that product portfolio and the robust global ecosystem they've managed to build around it.
And on the corporate front, moving beyond the pure numbers, they're getting some notable recognition for their sustainability efforts too, right? What stands out there?
Absolutely. For the second year running, they've been named in the Time World's Most Sustainable Companies list. They ranked 25th globally and first in the electronics, hardware, and equipment category specifically.
It's impressive.
It is. And they also received CDP's A-list recognition for climate and an A- for water security. This isn't just, good PR. It reflects concrete efforts in environmental stewardship,
Right.
which is increasingly important to investors, customers, everyone really.
Okay, let's circle back to their operations and maybe broader financial health. They've been quite open about this significant manufacturing reshaping program. What does that actually entail for the company?
That's right. As we touched on earlier, that Q2 operating loss of $133 million, well, it includes that $190 million charge, which was predominantly linked to this program. It's a company-wide effort, previously announced, aimed at reshaping their global manufacturing footprint and basically resizing their cost base for the future.
So investing now for later savings.
Pretty much. They plan to maintain their net capital expenditure plan for 2025, somewhere between $2 billion and $2.3 billion. And that's mainly to execute this reshaping, the long-term payoff they're targeting. They anticipate achieving annual cost savings in the high triple million dollar range by the time they exit 2027. So yeah, a significant investment now for greater efficiency down the road.
And what about inventory levels? That's been a hot topic for many semiconductor companies recently. Where do they stand?
Inventory at the end of Q2 was $3.27 billion. That translates to about 166 days of sales.
Yeah.
Now, that was slightly above their own expectation, but they do anticipate it will significantly decrease in Q3.
Okay, so expecting improvement there.
Yeah. And despite those restructuring charges hitting the P&L, their net financial position, their cash position essentially, remained pretty solid at $2.67 billion as of late June 2025. They also managed to pay out $81 million in cash dividends and executed $92 million in share buybacks during Q2. So that indicates, a continued commitment to shareholder returns even during this transitional period.
Okay, looking ahead then. What's the forecast for Q3? And maybe even looking towards Q4 2025. What does their guidance tell us about the trajectory from here?
All right, so for Q3 2025, they expect revenues around $3.17 billion at the midpoint. That would be a pretty healthy 14.6% sequential increase.
Sequentially strong, but still down year over year.
Right, still a 2.5% year-over-year decrease at that midpoint. But that sequential jump is definitely positive. They anticipate their gross margin to be about 33.5%. Now, that includes roughly 340 basis points of unused capacity charges.
Okay, and just to clarify for listeners, unused capacity charges are basically costs for factories not running at full steam.
Exactly. Costs they incur for equipment and overhead, even if demand isn't quite filling the factories yet, it hits profitability. They also expect a sequential negative impact on gross margin of about 140 basis points. That's mainly due to currency fluctuations and also the start of those non-recurring costs from the manufacturing reshaping program kicking in. About 20% of that impact comes from the restructuring.
Okay, so even with those gross margin headwinds, what does this guidance suggest for the company's return to overall year-on-year growth? Are they getting closer?
They expect all their end markets, with the exception of automotive, to be back to year-on-year growth in Q3. So that's a big step.
Right.
And then for Q4, they said they expect sequential revenue growth again and anticipate being at the turning point or very close to the turning point for achieving year-over-year growth for the company as a whole. That's assuming, of course, that the positive booking dynamics they're seeing continue.
That sounds like a pretty strong signal of recovery then, moving towards the end of the year.
It does suggest they feel confident they've seen the worst and are now on that path back to growth.
Okay. What about the specifics of silicon carbide? They mentioned strong price pressure, especially in China. How are they actually combating that pressure?
Good question. They're tackling it in a few ways. First, by accelerating the introduction of new generations of the technology. They're currently on Gen 4, actively working on Gen 5. Each new generation aims to improve performance and cost efficiency, helping them stay competitive.
Makes sense. What else?
They're also leveraging their manufacturing scale, specifically moving from 6-inch wafers to 8-inch wafers. That significantly increases the number of chips they can get per wafer, which lowers the cost per chip. And for China specifically, they'll have manufacturing starting up in Sanand, India, either late this year or early next. That should help with local costs and lead times for that market.
And broadening the applications too.
Yes, exactly. They're strategically expanding their Sydney efforts into the industrial market now, broadening the revenue base beyond just automotive. They believe they can maintain their target of around 30% market share in SiC, and they clearly see it as a midterm growth driver. They sound pretty bullish about 2026 being a significant growth year for silicon carbide.
Okay. And finally, this China for China strategy they mentioned. What does that actually entail for STMicroelectronics, and how crucial is that piece to their overall global presence?
Yeah. This seems to be a very active and pretty comprehensive strategy. They've essentially built up a localized presence there that
Mm.
includes manufacturing, design centers, application labs, local customer support, all designed so they can be perceived more like a domestic Chinese player rather than just a foreign supplier.
Interesting.
This strategy is particularly strong in areas like power products, including silicon carbide and also microcontrollers. And it's crucial because, as they pointed out, sales directly to Chinese customers currently account for about 13% to 14% of their total revenues. So it's a key part of their global footprint and really a strategic imperative in a market where that local presence and those relationships are just paramount.
Wow, what a deep dive that was. From navigating those tricky customer dynamics in automotive to powering the next generation of AI data centers and also pushing hard on sustainability, ST Microelectronics is clearly adapting to a really complex global environment and making some significant strategic bets.
It really is a testament, I think, to how established players in this semiconductor space are finding new ways to grow, but also how they're managing these significant operational shifts, investing heavily in their future to try and stay competitive and innovative. Their ability to balance these short-term market challenges with those longer-term strategic plays, that seems to be really defining their path forward right now.
So, as we look out towards the horizon, considering the constant evolution of global trade, technological demand, what new frontiers might things like microcontrollers, smart power, advanced sensors conquer next? Things we maybe haven't even fully imagined yet. And maybe more fundamentally, how might these ongoing strategic transformations, like the ones we see at ST Microelectronics, ultimately redefine what it even means to be a global leader in semiconductors? Not just for today, but for the decades to come. Definitely something to mull over until our next deep dive.